I'm going to share something that changed how I think about this. In March of 2023, multiple major bullion dealers simultaneously froze their entire sales operations. Not slow delivery, not premium increases, complete sales freezes. And if you've been in this market for any length of time, you know that's not supposed to happen. Dealers make money by selling metal. Stopping sales is like a restaurant refusing customers during dinner rush. It's financially suicidal unless something far more significant is happening behind the curtain. Let me take you back to understand why this matters. The bullion dealer network operates on thin margins, typically between 3 and 8% depending on product type and market conditions. Their entire business model depends on continuous flow. They buy from mints and refineries, sell to retail customers, and the velocity of that turnover is where they generate profit. When that flow stops, they're not just losing potential sales. They're watching their capital sit frozen while still carrying overhead, staff costs, and facility expenses. So when dealers choose to freeze sales, they're making a calculated decision that the risk of selling at current prices exceeds the risk of zero revenue. Think about what that calculation requires. They're looking at their acquisition costs, their current inventory, and their forward pricing expectations, and they're concluding that if they sell now, they'll be unable to replace that inventory without taking catastrophic losses. What's remarkable about this is the mainstream financial media barely mentioned it. A few trade publications covered it as a curiosity. Some finance blogs noted the phenomenon. But the major networks that spend hours dissecting every quarter-point move in interest rates somehow missed an unprecedented disruption in the physical precious metals market. I've been tracking dealer behavior since the 2008 crisis, and I've seen premiums spike. I've seen delivery delays stretch from weeks to months. I've seen allocation systems where dealers limit purchases per customer. But complete sales freezes across multiple major dealers simultaneously, that's a different category of event entirely. Let's go back further to understand the historical context. The bullion dealer network as we know it today really emerged in the 1970s after Nixon closed the gold window in 1971. Before that, gold ownership for American citizens had been illegal since 1933. The market was small, specialized, and primarily institutional. But when Ford legalized private gold ownership in 1974, a retail market exploded into existence. Early dealers operated in a relatively stable environment. Gold prices were rising through the 1970s, creating consistent demand, and the supply chains were establishing themselves. Dealers learned to manage inventory risk through futures hedging and careful timing of purchases from mints and refineries. The system worked because there was general equilibrium between supply and demand, with prices adjusting smoothly to clear the market. The first major stress test came in 1980 when gold hit $850 an ounce before crashing back down. Some dealers got caught holding expensive inventory that suddenly lost half its value within months. A few went bankrupt. But the ones who survived learned crucial lessons about hedging and inventory management. They built systems to protect themselves from price volatility. The next 20 years were relatively quiet. Gold entered a bear market that lasted until roughly 2001. Dealers operated in a low-volume, low-volatility environment. The business was steady but unglamorous. Then something started changing in the early 2000s. Gold began a sustained bull market that would last over a decade. From 2001 to 2011, gold went from around $250 to over $1,900 per ounce. Dealer volumes exploded. New dealers entered the market. The industry expanded dramatically. And through all of that growth and all that price appreciation, the fundamental business model remained intact. Prices rose, premiums stayed relatively stable, and the flow of metal continued uninterrupted. Even during the 2008 financial crisis, when global markets were melting down and Lehman Brothers was collapsing, dealers kept selling. Premiums spiked significantly. Delivery times extended. Some products became temporarily unavailable, but dealers kept taking orders and kept moving metal. The system bent under stress but didn't break. Here's what this really means. When dealers freeze sales in 2023, they're signaling that current conditions represent a more severe supply crisis than what we experienced during the worst financial catastrophe since the Great Depression. Let that sink in for a moment. Remember this point. The mechanics of what happened in March 2023 are instructive. It started with the banking crisis. Silicon Valley Bank collapsed on March 10th. Signature Bank followed on March 12th. First Republic was teetering. Credit Suisse was being emergency merged into UBS. The entire banking system looked fragile in a way it hadn't since 2008, and the market response was immediate. Investors flooded into precious metals. But here's where the story diverges from previous crises. The paper markets for gold and silver contracts on the COMEX remained relatively orderly. Prices rose, certainly, but there was no massive spike. No circuit breakers, no trading halts. The futures markets were functioning normally. But in the physical market, something entirely different was happening. Demand for physical bullion products surged to levels that made 2008 look like a routine Tuesday. American Eagle coins, Canadian maple leafs, generic rounds, bars of all sizes, the entire product range saw simultaneous explosive demand. Dealers started reporting wait times of 4 to 6 weeks for products that normally shipped within days. Premiums on silver eagles jumped from $3 over spot to $12 over spot in some markets. And then several major dealers simply stopped taking new orders entirely. I want you to understand the decision matrix here because it reveals something critical about market structure. A dealer sitting on inventory during a price run-up faces a straightforward calculation. If they believe prices are going higher, they want to delay sales to capture that appreciation. But that's not what was happening in March 2023. Spot prices were rising, certainly, but not dramatically. Gold went from around $1,800 to about $2,000. Meaningful, but not a moonshot. What was moving dramatically was the spread between spot price and physical product prices. That spread, what we call the premium, represents the real-world scarcity of actual metal you can hold in your hand versus the paper claims traded electronically. When that premium explodes while spot price remains relatively calm, you're seeing a fundamental disconnect between the paper market and the physical market. Now let's take this a step further. This disconnect reveals the essential fraud at the center of precious metals pricing. The spot price that everyone references, that appears on financial websites and cable news tickers, is determined almost entirely by futures contracts traded on exchanges like the COMEX. These are paper contracts where the vast majority settle in cash rather than physical delivery. According to the COMEX's own data, the ratio of paper claims to actual deliverable physical metal often exceeds 100 to 1. In some periods during high volatility, it's been estimated at over 250 to 1. This means that for every actual ounce of gold sitting in COMEX warehouses, there are hundreds of paper claims, representing ownership of that same ounce. This works fine as long as everyone plays along and accepts cash settlement. It's a massive game of musical chairs where the music never stops, so nobody notices there aren't enough chairs. But when physical demand surges and people start demanding actual metal instead of cash equivalents, the entire structure becomes unstable. What dealers saw in March 2023 was the beginning of that instability. They could sell their inventory at prevailing premiums, certainly, but when they went to replace that inventory from their suppliers, the mints, the refineries, the wholesalers, they found that replacement inventory either wasn't available at any price, or was only available at premiums far higher than what they could sell to retail customers. Put yourself in their position. You sell 100 ounces of gold eagles at a 12% premium over spot. You've made your margin, everything looks fine. But when you go to reorder those 100 ounces from your supplier, you find that the supplier wants an 18% premium. Or they're not accepting new orders, or they'll accept your order, but can't guarantee delivery for 8 weeks. Now you've got a problem. If you keep selling at 12% while replacement costs are 18%, you're destroying your business. If you raise your retail premiums to 18% to cover your replacement costs, you'll be undercut by competitors who still have inventory purchased at lower premiums. The rational response is to freeze sales until the market stabilizes and you can see where replacement costs will actually land. This is exactly what happened. And it happened across multiple dealers simultaneously because they were all getting the same signals from their upstream suppliers. The entire supply chain was seizing up. Now, the official explanation you heard, if you heard anything at all, was that this was temporary disruption caused by pandemic-related supply chain issues combined with a surge in demand during banking instability. Just a brief mismatch between supply and demand that would resolve itself quickly as mints increased production. And to be fair, that explanation contains elements of truth. Mints had reduced production during the pandemic. Shipping and logistics were disrupted. Labor shortages affected refineries. All of that was real. But here's what that explanation carefully avoids addressing. Why did paper markets remain calm while physical markets seized? If the issue was simply overall supply and demand for gold as an asset, both markets should move together. Instead, we saw massive divergence. You could buy unlimited quantities of gold futures contracts at spot price plus minimal carrying costs, but you couldn't buy physical gold coins at anywhere near that price, and in some cases, couldn't buy them at all. This tells you that investors were specifically rejecting paper claims in favor of physical possession. They didn't trust the paper system to deliver when needed. And that's a crisis of confidence that goes far beyond temporary supply chain disruptions. What's even more revealing is how the mints responded. The United States Mint, which produces American Eagle coins, has a legal mandate under the American Eagle Coin Program to produce sufficient quantities to meet public demand. That's not a suggestion. It's federal law, specifically 31 U.S.C. paragraph 5112. Yet, during periods of peak demand in 2023, the Mint repeatedly failed to meet demand, citing unprecedented demand and production constraints. They were literally unable or unwilling to fulfill their legal mandate. And the consequences for that failure? Absolutely nothing. No congressional hearings, no regulatory action, no media investigations. The Royal Canadian Mint, the Perth Mint in Australia, private refineries around the world all reported similar issues. Demand was exceeding their ability to produce, even though the raw materials were available and spot prices would have made production profitable. Think about what this means economically. When demand exceeds supply in a normal market, prices rise until they reach a level that both incentivizes increased production and reduces demand to the point where the market clears. That's basic price discovery. But in the precious metals market, you had explosive demand, insufficient supply, and yet the official spot price barely budged. How is that possible? It's possible because the spot price isn't actually determined by supply and demand for physical metal. It's determined by the trading of paper contracts, and there's functionally unlimited supply of paper contracts. The banks and institutions that create these contracts can print as many as needed to keep the price suppressed, as long as they can continue settling in cash rather than physical delivery. Don't miss this. This is the core mechanism of price suppression, the paper tail wagging the physical dog. And dealer freezes in March 2023 were the dog finally starting to notice something was wrong. Now, let us trace how this evolved from March through the rest of 2023 and into 2024. The initial freeze lasted roughly 2 to 4 weeks for most dealers. Some resumed limited sales with dramatically higher premiums. Others implemented allocation systems limiting purchases per customer. Gradually, the acute crisis phase passed, but the underlying dynamics didn't resolve. Throughout 2023, premiums remained elevated compared to historical norms. Products that traditionally carried premiums of 5 to 8% over spot were trading at 10 to 15% over spot. Delivery times that used to be measured in days were measured in weeks. The mints did increase production, but never caught up with demand. They operated at or near capacity while still maintaining waiting lists. The physical market remained tight, even as the acute banking crisis faded from headlines. Then we saw something fascinating. In late 2023 and early 2024, major central banks around the world continued to be massive net buyers of physical gold. China, Russia, India, Turkey, Poland, countries across the political spectrum were accumulating gold reserves at rates not seen in decades. According to the World Gold Council, central banks purchased over 1,000 metric tons of gold in 2022, the highest level since 1967. In 2023, they purchased another 1,037 metric tons. And here's the critical detail. These are reported purchases. Many analysts believe actual accumulation is significantly higher, with some countries making unreported purchases through intermediaries. Why would central banks be aggressively accumulating physical gold during the same period that retail dealers are freezing sales due to supply constraints? They're seeing the same fundamental reality. The paper system is increasingly divorced from physical reality, and when confidence breaks, physical metal is what matters. Here's what happened in parallel that most people missed. While the physical bullion market was seizing up in March 2023, something else was happening in the broader monetary system. The Federal Reserve launched the Bank Term Funding Program, effectively providing unlimited liquidity to banks using Treasury securities as collateral at par value, regardless of their actual market value. This was extraordinary monetary intervention disguised as a technical lending facility. Banks holding long-dated treasuries that had lost significant market value due to rising interest rates could suddenly borrow against them at full face value. The Fed was essentially backstopping the entire banking system's interest rate risk. And they had to do this because the alternative was a cascade of bank failures that would have dwarfed 2008. The unrealized losses sitting on bank balance sheets and treasury holdings alone were estimated at over $600 billion in March 2023. If banks had been forced to realize those losses through deposit withdrawals, dozens of institutions would have become insolvent overnight. So the Fed stepped in with a backdoor bailout while telling the public that everything was under control and no taxpayer money was at risk. And people who understood what was really happening rushed to convert their paper wealth into physical assets that couldn't be conjured into existence by Federal Reserve programs. This is the context in which bullion dealers froze sales. Not just increased demand, not just supply chain issues. A fundamental crisis of confidence in the entire financial system's ability to honor its paper commitments. Now bring this forward to current conditions. As I'm putting this together, we're seeing new stress points emerging. Banking sector concerns haven't disappeared. They've been papered over with Fed liquidity programs, but the underlying issues of duration risk and commercial real estate exposure remain unresolved. The national debt is approaching $35 trillion. Annual deficits are running over $2 trillion. The federal government now spends more on interest payments alone than on national defense. This is unsustainable, and everyone in markets knows it, even if they won't say it publicly. The traditional response to this kind of fiscal crisis would be significant inflation to reduce the real value of debt. But we're told inflation is under control, running at 2 to 3% according to official measures. Meanwhile, anyone who buys groceries or pays rent knows that lived inflation is running far higher than official statistics admit. In this environment, precious metals should theoretically be surging. Every historical precedent suggests gold should be at $3,000 or higher. Silver should be proportionally elevated. Yet price action remains constrained by the paper markets that can create unlimited supply of contracts. But the physical market is telling a different story. Premiums remain elevated, supply remains tight, and dealers remain cautious about inventory management in ways they weren't before March 2023. Let's take this a step further. What we're witnessing is a slow-motion breakdown of the paper price suppression mechanism. It's not a dramatic crash or explosion. It's a gradual erosion of confidence where more and more market participants reject paper claims in favor of physical possession. You can see this in the data if you know where to look. The COMEX registered gold inventory, gold available for immediate delivery, has been declining as a percentage of total open interest. More claims chasing less deliverable metal. The ratio keeps getting more extreme. Exchange-traded funds that claim to hold physical gold keep changing their prospectuses to allow for various forms of synthetic exposure and cash settlement under certain circumstances. They're building in escape hatches for when physical delivery becomes impossible. Even major bullion banks that make markets in precious metals have been reducing their exposure and pulling back from certain activities. The list of authorized COMEX depositories and the active market makers has been gradually shrinking. These are all symptoms of a system under structural stress. Not acute crisis that resolves quickly, but chronic dysfunction that persists and gradually worsens. Now, remember this point. The dealer freezes in March 2023 were a warning sign, a canary in the coal mine moment, and the response from authorities and mainstream media was to essentially ignore it and wait for it to pass. No investigation into why the market seized, no examination of the paper versus physical disconnect, no discussion of whether the current price discovery mechanism actually represents genuine market dynamics. Just wait it out. Assure everyone everything is fine and hope confidence holds long enough for memories to fade. But markets have longer memories than politicians hope. And the participants who experienced those freezes, who couldn't get metal at any price for weeks, who watched the paper markets trade calmly while the physical market seized, those participants learned something that can't be unlearned. They learned that when the system is stressed, paper claims become unreliable. They learned that physical possession is the only guarantee. They learned that mainstream assurances of stability are worth exactly nothing when you're trying to take delivery of actual metal. And once that lesson is learned by a critical mass of market participants, the entire fractional reserve precious metal system becomes unstable because it only works if people accept paper as equivalent to physical. When they stop accepting that equivalence, the game ends. We're not at the end game yet. The system is still functioning. You can still buy bullion products, even if premiums are higher and delivery takes longer than historical norms. The music is still playing. But the dealers who froze sales in March 2023 showed us that they can see the chairs are limited. So what does all this mean for you? It means that the bullion dealer freezes weren't an anomaly. They were a preview, a stress test that revealed fundamental fragility in how precious metals are priced and delivered. If you're holding paper claims on precious metals, ETFs, certificates, allocated accounts with counterparty risk, understand that those may not be convertible to physical metal when you most need them. The March 2023 episode demonstrated that physical supply can disappear even while paper trading continues normally. If you're planning to acquire physical metals as part of a broader wealth preservation strategy, understand that future supply disruptions are likely to be more severe, not less. The structural issues that caused the March freezes haven't been resolved. They've been deferred. If you're watching mainstream financial media for signals about precious metals markets, understand that they either don't understand or won't report on the physical versus paper disconnect. You saw how they covered the dealer freezes, which is to say, they barely covered them at all. The dealers who froze sales made a calculated risk assessment. They looked at what was happening in physical markets versus paper markets, and they determined that protecting their inventory was more important than maintaining sales flow. That's an extreme decision that tells you everything about what they were seeing in real-time market conditions. And those conditions haven't fundamentally changed. We're still operating in a system where paper claims vastly exceed physical metal. We're still in a fiscal and monetary environment that's historically unprecedented in its dysfunction. We're still seeing central banks accumulate physical metal while telling their citizens that fiat currencies are stable. The dealer freezes of March 2023 were the system showing you its true nature under stress. Pay attention to what you saw, because next time the freeze might not